From high inflation to geopolitical risks to the recent bank failures, the stock market has been on a roller coaster ride. But this can be an opportunity for stock pickers. Joining us now, one of the most successful, billionaire investor Mario Gabelli of GAMCO Investors. Mario, it's so great to have you on Overtime. Welcome.
Well, I'm glad to be on your show, and congratulations on your new program time. Thank you.
There's so much to talk to you about. I was going to start this conversation around inflation, given the CPI data we got this morning, but given the events of the afternoon with this Russian fighter jet downing a U.S. Reaper drone that was operating over the Black Sea today, I think we need to start with geopolitics, since you are such a significant investor in the aerospace and defense sector. Your thoughts?
Well, look, if you sat here 3 years ago, you wouldn't have thought about a product coming out of Wuhan. You wouldn't have thought about a ground war in Russia. You don't think about what's going on between Iran and Israel, what's going on in North Korea with hypersonic missiles. You don't think about what Xi might do or not do with regards to China. And they'd say center row orchestra. So the Defense Department of the United States, the Defense Department of Japan, the Defense Department of NATO, the Defense Departments of those NATO countries are all saying, listen, we have to be better prepared. So the notion of our own defense budget in the United States going up to X dollars, it was just announced the other day, let's call it $800 billion. And you look at the amount that the Chinese are putting in, 230, it sounds lower, but look at the expenses. And so the notion of investing in an area that is for our safety, look at China with regards to what they're doing in the South China Seas. Look at what China with regards to the China One policy, with regards to Taiwan. So those are the issues. We hope that the world is peaceful. We like that. We like the notion of growth for the economies, the raising of living standards around the world. We need a food crisis, a water crisis, an energy crisis, but we also have to be prepared. And so in terms of the stocks that I like, we could talk about several of those, one of which I kind of call 4 T's, actually, TTT, but one is the defense stock, and that's Textron. Textron has 205 or 10 million shares outstanding. The stock's about $70, call it 69 or 70. You're talking about a $14 or $15 billion market cap. They'll earn $6 or $7. One of the programs for their Bell helicopter division is a replacement of the Black Hawk, which is called a Flora program. So, that would be an example. Crane is spinning off their merchandising business. That stock, when issued, will also be attractive. But these companies are also tied in with what's going on with Boeing, what's going on with Airbus, what's going on with Comac 919, which is the Chinese version of some commercial aircraft. And the commercial aircraft business is doing quite well at the moment. And backlog shipments are rising, and the incoming orders for these companies are doing quite well. So, that's the way we look at it.
Yeah, and of course, Boeing having a really good day today, too. I think finishing the day up about 2% after announcing another big commercial jet order with the different Saudi airlines that are being stood up as well. How real is the risk regarding geopolitics and rising tensions? I guess for investors in this market, how do you balance that versus everything we're seeing play out on the macroeconomic stage, whether it is high inflation, whether it is the debate now around what the Fed is going to do next week, given what we've seen with the bank failures?
That was a great question. And, you have to make an observation of what's going on in the banking sector, okay? And so you look back, there's a lot of crises there in the last 50 years, 60 years. I remember the Continental Illinois Bank, the Republic National Bank, the Herstatt Bank, all having challenges back in different time periods. And obviously, just recently, 15 years ago, was Lehman Bear and so on. But the one that sticks in my mind for this meeting, for this conversation, is the fact that in 1989-90, you had a savings and loan crisis. And what the accountants did, and this is important, the accountants passed a rule that said, I think it was FASB, whatever, and it's got a code by the accountants. And they basically said, look, if you have an investment, either you you can hold it to maturity, HTM, or you have an available for sale accounting, which means you buy and sell and you market to market or market to best value immediately. And what happened in the last couple of years is when interest rates reasonably low, or zero for a period of time, money flowing into the banks and staying in commercial deposits, or basically in a low-cost bank deposit or whatever, or a checking account. All of a sudden, everybody starts lending, borrowing, and making investments long, thinking they could buy a 10-year T-bill, a Treasury, not bill, but a Treasury note. And now, all of a sudden, you, with the public annual reports coming out, you look with a laser on them and you see the losses that have not been recognized.
Right, lots of surprises, right? Because rates went up so fast. And I wonder, kind of connected to that and the overall economic situation, what is your base assumption for what happens to the consumer in the back half of the year because of reduced savings, more credit card debt, and how that affects stocks?
It's a great look. We don't look at things that slowly. Look, I started my firm, I started as a sell-side analyst in 1966. The Dow was 1,000. 15 years later, after I had already, when I started my firm, it was 1,000. So, you know, I think during the next period of time, the markets may be flat for 2 or 3 years, but you can still make a lot of money, which we did during that relevant period. So that's my dynamic. Now, let's go back to your details. The International Monetary Fund, IMF, in October of 2022, the last time they issued some numbers, and they're going to update them shortly, said the world GDP is going to be 108 trillion. Of the 108 trillion, China is 20%. The United States is 24%. And Europe is 17. I am in the camp that you have to look globally. And China is going to be up sharply in the second half of 2024 versus the second half of 2021. And that'll have an impact on macro demand, everything constant in the geopolitical world. The second part is the United States. Look at the consumer. The balance sheet just came out for the fourth quarter. Consumer wealth was very substantially above expectations at that period of time. Loans are 18 trillion, up from 13 trillion. So there's spending power. Now let's break the consumer down. It's 70% of GDP. And I don't look at this stuff. I just know it. But autos, which I'm importantly involved in, because that's one of our ecosystems that we have accumulated and compounded knowledge on. Autos, inventory at the dealer level at the end of March, I think the industry has, and I live with the number, about 1.9 million. The average for the previous 10 years was 3.9. And even if they don't order that much, that is going to be an important part of that ecosystem. Then the second part is the consumer obviously has to have higher wages to offset the inflation that you saw today in terms of wages. Rents were supposed to come down. They didn't come down. So those are the dynamics. Now, more importantly than that, when I look at the balance sheets of companies, the managements this cycle have finally learned how to deal with buying inventory, how to pass through pricing, how to adjust their contracts. And so that the learning curve of working capital for the industrial part, which is not as important as in the 70s, but it's still important, they're handling that inventory and commodities, and you double ordered, you're canceling orders. So those are pretty dynamic elements. And, you know, that's the way I look at the consumer. I think it'll be okay in the second half of the year, even with the current interest rates.
And I want to get into some of those consumer stock picks and also some of those industrial picks with you as well. Mario, we're going to take a quick break. If you could just stay with us, and we will finish this conversation on the other side of this break. It was Mario Gabelli. Mario, I want to get your thoughts on Lennar, because a 10% drop in orders, as Diana just mentioned, not so bad for a rate-sensitive area of the market that has just been hit so hard as the Fed has tightened.
You got a lot of facets to that question. First, you know, the Powell has to continue to look at the whole subject, the rates, runoff of the debt that he inherited, even though he's putting a lot of that back. You know, they put down that he inherited, created during the last 3 years. And basically, they took down about $840 billion, but they're going to have to put that back into the system. But that second area, you asked me about consumer of 70%. Housing is about 10, industrials, which housing is an element, as the economists would say. That's an important part. And from my end, you know, I bought my first house at a 6% mortgage a few years ago at $35,000. And today, going back to 6%, we're going to have to get used to it. The tax deduction is not as easy as it once was because prices have gone up and you're lagging that policy. But from Lennar's point of view, the other thing you should think about, don't buy the stock. buy the voting stock. The voting stock sells at $16 discount. You had companies families that controlled, like the one up in Victor, New York, where they got a significant cash premium for converting, that's Constellation Brands, their voting stock into ordinary voting stock, like every other shareholder. And you got that with several other companies. Okay, a company out in Long Island did the same thing. So all I have to do is buy the higher voting stock at a $15 or $16, Lennard.B, and that's the way I would play that. You got a good business with a good management. I just like to make sure you're buying the right instrument. It's Gresham's law that says, buy the better product because you're driving out the good will drive out the bad over time. In any event, with regards to going back to your question about other stocks that I like, let's talk about TTT. I gave you Crane, I gave you Textron in the defense area and commercial aviation. But in the terms of the other T is Tegna. Tegna is a stock with about 210 million shares. I say that because I don't know what they've been buying back in the last 3 or 4 weeks. Okay. And basically the stock is 15.5. They operate TV stations. They had a deal with a Sue Kim, Standard General, to be bought at $24. The stock is $15.50. I think that 2 years from now, even if the federal FCC has given them some kind of a stalemate by doing something that was unusual, and basically either way, I think they'll earn $3 in 2024. Broadcasting is going to do extremely well in a political environment year of next year. And secondly, the companies that we talk to, like Procter & Gamble and so on, and consumer products companies in the food area, are starting to bring back new ideas, and they're going to spend money on it. And the car dealers are going to spend more money. So it's a very good picture. Tegna is a win without a deal. It's a win with a deal. Okay. And the other T that I would tell you is a German company called Traton. There's 500 million shares at 18. Basically, we were one of the largest shareholders with Carl Icahn of Navistar. They bought Navistar. So it's the MAN group in Europe. It's 90% owned by Volkswagen. So there's 50 million shares outstanding. And those earnings are going to do extremely well, independent of these cycles, because Navistar is coming back under their stewardship. So those are the 3 T's that I would like in different industries in different parts of the world. Okay. I do want to get your thoughts more broadly on the media landscape, given the fact that you made your name, at least in part, on your successful track record investing in that industry. We saw the short-lived proxy war for Disney. You've got belt tightening across the industry. The focus has shifted from growth at all costs as these legacy media companies have rolled out their streaming services to now profitability and how they're going to make money doing it. Who are the winners? Do we know yet? Yeah, well, theatrical box office used to be you and I going to the movie theater was 42 billion. China was about 13 or 14 billion of that. That's coming back along with gaming in Macau. Basically, that's theatrical. Now, Netflix, kind of showed you Glass Onion briefly in the movies to do whatever. I don't know what they were doing. But bottom line, the amount of money on content is significant. And I'll just have to read the number. It was estimated for this year at about $130 billion for all the companies. 3 or 4 years ago, it was $90 billion. So you've got that content as out-of-pocket cash. Then they put it into, part of it is not amortized. Then it goes through the inventory, and that goes through the P&L. That's flattening out. Okay. Now, I'm assuming that the Writers Guild, the Screen Actors Guild, all of those strikes are not going to hobble anything at the short term. So what companies do I think will make a lot of money 2.5 years from now where you can double and triple your money? I have to focus on Paramount. Paramount has 650 million shares, good content, good management. Obviously, they're suffering negative cash flow short term over the next year or so from going into direct to the consumer, called streaming and other dynamics. But they have good content. They know how to make it. They know how to run it. Bacchus is doing a good job. Then you got Zaslav at Discovery. He took on Warner Brothers and obviously had a few potholes that he didn't think about. That stock's around $14. Again, 1 point. And that's it. So we like those. All right. I have to ask you one more
question quickly. I spoke to Scott Wine, the CEO of CNH Industrial, earlier today. I got his outlook on the heavy machinery landscape, given the fact that they sell machines into construction and agriculture. I just want to play a soundbite from that. Take a listen.
Certainly, the immediate signs for our direct markets are still quite good. I do believe that the likelihood of a recession is quite real, but because of we trade more on the ag cycle, and the ag cycle continues to be strong. Soft commodity prices, while they've drifted down a little bit, are still above the historical norms. And on the construction side, again, we see strong demand in most of our markets. So certainly, I think the overall global economy may weaken, but we like our current end markets right now.
You're invested in this name. Just final thoughts, whether it's this company, the industrial landscape, or the economy in general.
IRA, IIJA are two acts that will benefit the whole equipment area. He's in ConExpo in Las Vegas. I have two analysts there looking at and kicking tires, so to speak. Case New Holland's around $15, 1.3 billion shares. You got to buy it.
Mario Gabelli, thank you so much for joining us today. We appreciate your insights and your picks.